The cash flow statement shows how a company generated and used cash during an accounting period. Cash flow is fundamental to a company's ability to stay in business, and even a fundamentally sound company can fail if it runs out of cash. So the cash flow statement is very important. It's needed because the revenue and expense figures on the income statement include non-cash items. For example, under accrual accounting, a company might record revenue for goods sold on credit before it receives payment, but of course that revenue can't be used to pay for things until it turns into actual cash. In many ways, the cash flow statement is like a bank statement. It shows what a company spent its cash on and what the sources of that cash were. Cash flow is also similar to a bank account in that it's unambiguous. Once a transaction occurs and the cash is used, the cash is gone, no matter what accounting techniques are used. The cash flow statement is considered the most transparent of the financial statements because it's less susceptible to estimates and assumptions made by a company's management when preparing the other financial statements. This is because many non-cash items are dependent on management estimates and discretion, and their treatment may vary slightly from company to company. As well as showing the total cash changes during an accounting period, the cash flow statement tells you whether cash is coming from operations, or whether it's being provided by bank loans or by selling stock, and whether a firm is reinvesting in itself. As we'll see, it's broken down into cash flow from operations, investing, and financing activities. Cash flow statements are used in important ways. For example, they help companies develop cash forecasts and budgets by showing them how much cash their operations can provide. They help banks determine if a company will have enough cash in the future to pay loans, by showing them whether its cash flow from operations is sufficient to support loan payments. And they help investors determine a company's financial health by showing them how long a company might be able to survive without further investment, or how much cash may be available to put back into the company.